Is it possible to consistently beat the market, or everything is just already priced in? In the world of quantitative trading, few theories is more controversial or misunderstood than the efficient market hypothesis, or we call it as efficient market theory. Before we dive into more details, what is the efficient market theory about? So the efficient market theory hypothesis is the idea that financial markets are informationally efficient. That means that all available information, regardless like public news, private news, financial statement, or even rumors, is already reflected in the price for an asset. According to EMH, trying to beat the markets through analysis or prediction is pointless because the market is already knows everything you do. So essentially, if the markets are efficient, everything that could be influenced price movement, whether it is a tweet or engagement report, is already baked and reflected into the price straight away when you know that. Now, the question is the market really efficient? Obviously, the answer is no. Why? Because it's no. Because all the information that we get is limited. We just based on the limited information. This can be visualized as a retail trader and institution. Institution, then of course, they know a lot of insider news, a lot of things that can react fast before the retail traders actually do. So they can front run them. Because of the information gap, the market is not efficient. Let me just give you a very simple example. You are selling a bottle in two different places. We are selling a bottle in Singapore and you're selling a bottle in Malaysia. These two bottles, right, you are selling around $1. So $1 in Singapore, $1 in Malaysia. So this is a case study of an efficient market. When the price of $1 rise in Singapore, for example, it rise to $1.50. Malaysia also rise to $1.50 very fast. So this is called an efficient market where there is no room to each. There is no room to earn money, there is no profit, right? You cannot buy from Malaysia and sell it in Singapore because the information is the same. But what if the market is inefficient? Take back the same example as Singapore and Malaysia. In Singapore, you are selling around $1, but in Malaysia, you are selling about $1.50. So what happened? As a smart business guy, when you spot these two different scenarios, right, you tend to do business already. What you need to do is you just buy from Singapore from $1 and you just sell at Malaysia at $1.50. So you have a profit of 50 cents. So this one is called information gap, because the information of selling this is you are the only one who know this information, then you can exploit this information to take it as your edge. So what if a lot of people know this information already? This is a business information. So what if a lot of people know, wow, this Singapore sell very cheap, Malaysia sell very expensive? What do this happen? More people will buy from Singapore. For example, if mineral water is cost $1, right? But because a lot of people know this business already, when the people are keep buying, the demand is high. So the price will tend to rise up. For example, go to $1.30. And what happened to the Malaysia? A lot of people are buying from Singapore and selling at Malaysia. So Malaysia price will be dropped lah, because the demand here is already, the supply here is already a lot already. Until a certain age, they will converge back into a significance level. So this level we call it as market efficient theory. So when they converge it to certain price age which is same, for example, $1.20 in Singapore, $1.20 in Malaysia, this is called efficient market, where there is no room to trade, no rooms to grow everything. Obviously, when we apply this to financial market, do you think that it is no? It's definitely no. If the financial market is very efficient, then all the backtesting, modeling, and trading strategy in quant finance are useless, because there are no room to grow. Why do quant traders still making money? Here is the key. Financial market theory is just a theory, and markets are not perfectly inefficient, because a lot of things that the retail traders know, there are a big gap between retail trader information, the information that retail trader can get and the institutional traders can get. So this is the price difference. This is the market inefficient already. This is the reason why there is always room to trade in the financial market. So here are some of the potentials that cause this kind of inefficient. So there are delay, bias, human behaviors, and structural gaps. Market react at different speeds. Human psychology creates inefficiencies that they can be exploited, and there's where quant traders come in, finding all these imperfection and profitable from them. So if the financial market is efficient in theory, the real world market are full of little inefficiencies that quant trader can exploit. So the real world markets events often break the efficient market theory. So take about the flash crashes, for example, where the market dropped drastically in seconds based on panic selling, or earnings surprise based where the stock shoot up and down unexpectedly. Because the financial is full of inefficient, as a quant trader, we can exploit this inefficient and make it disappear. So this means that the game is always changing. As soon as the quant model discover a profitable edge, the more people exploit it, and then soon the edge will vanish. And then that's why alpha doesn't last forever. Just like the example that I shared during the initial stage of this video, I share about where a lot of people know this kind of business model, buying from Singapore and selling in Malaysia. A lot of people know that already. So there's no room to grow. Same like we as a quant trader, we do a lot of alphas, we do a lot of strategies, right? If a lot of quant strategies are being discovered a profitable edge, the more people exploit it, the more people know the edge, soon the edge will vanish, and this is why alpha doesn't last forever. So this dynamic environment is one of the things that makes quantitative trading so much challenging and exciting. So we are a race against other algorithms to find new efficiency before they actually disappear. So there was a famous quote by this Eugene Fama: markets are efficient to the degree that smart people make them efficient. So smart people will make the market always efficient, because if there is an inefficient, there is the opportunity for us to make money, just like the business that I shared in the video. So now here is the paradox. If the market were totally 100% efficient, there would no reason to trade, no profit, no edge, everything could be just priced perfectly. But if nobody tried to beat the market couldn't stay efficient. The very act of trading, of exploiting inefficient, is what keeps the financial market efficient. It is a cycle that keeps the market evolving. For example, if there is inefficient already, when there are a lot of traders are making use of it, it will become efficient again. Then a lot of people are exploiting it to make money, and it will converge back to efficient already. So this is like the art of trading. Exploiting inefficiency is what keeps the market efficient. Because when you're exploiting inefficiency, then the market will converge it to efficient states. Think about it is this way. Even time someone exploit inefficient and profits, it forces the market to become more efficient and eliminating the edge. But then new opportunity arises, then the cycle continues. This will continue on the cycle, and it keeps happening on the markets. There is another reason why quant trading is such a fascinating game, and it's a game changer. So is the market really efficient? I can say yes, but not perfectly. In theory, the efficient market holds true, but in practice, markets are not 100% efficient. There are tiny gaps left behind those inefficiencies, and where the quant traders join and make the money from it. So if you want to make money in quantitative trading, you need to understand the maths and market psychology that can turn these inefficiencies into opportunities. Next time someone tell you that the market are always efficient, remember that the gaps between theory and reality, there is your edge. Want to dive deeper into maths, models and strategies that challenge the market financials? Hit the like, subscribe button, and I will see you in the next video.